Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of credibility in offshore tax and FBAR cases, why it's important to be credible, and what happens if the judge, the jury, IRS examiners and agents and special agents don't find you credible, how it could impact your case. So let's go through the basics. When it comes to fraud, there's a concept called badges of fraud, and there's various factors that judges, the IRS, etc., will look into to determine whether or not they think someone may have committed fraud. Fraud is super important to try to stay away from because, especially if it's civil fraud, there's no statute of limitations. In other words, the IRS could feasibly go back as far as they want in order to go after someone for fraud. They tend to hover around the 6-year statute mark just because there's other hoops and hurdles that they have to go through in order to pursue further back than 6 years. But still, the ordinary statute of limitations is normally 3 years, so you're already off to a bad start. But idea is different badges of fraud together helps the decider determine whether or not someone may have committed fraud, and credibility tends to be one of the more important aspects or one of the more important factors to determine whether or not someone committed fraud. The basics for credibility is simply, are you trustworthy? Are you believable? Are the words that are coming out of your mouth something that would make someone believe that what you're saying is true? Is it convincing? Does it make sense? What you're saying goes with the facts and circumstances so that someone will believe you. If not, there's no dice, and obviously there could be negative impact and negative consequences. So when it comes to offshore tax and FBAR, why don't we go through some of the basics on how credibility could impact whether or not you're going to convince the higher ups that you're credible. Okay. 1, let's say that let's say you had an FBAR filing requirement, right? And let's say that there were various accounts that were reported and some accounts that were not reported. Let's say it was the higher balance accounts that weren't reported. You reported some accounts, that had $10,000, $15,000, $20,000, but you're missing 2 accounts worth $3 million. Okay. Let's say at the outset, you might look at that and go, well, there's no way someone could be credible and not report the large balances. They only report the small balances. But let's say that the balances that were reported were bank accounts, right? Because FBAR people think bank accounts. But let's say actually those large accounts are maybe an Australian superannuation or CPF in Singapore, pension accounts, right? Oftentimes in these other countries, these are equivalent to like 401k and Social Security hybrids. They're required, they're mandatory, they're compulsory. Most people don't think of it as an account per se. They don't think of it as something that would have to be reported on the FBAR. Person might be credible, right? Maybe they reported their bank accounts dutifully from when they first came to the U.S. When they first opened the accounts, there's no prior penalties or things like that. And the accounts that weren't reported are not really accounts per se. Maybe there was also some life insurance policies or just things that had high values but are not something that automatically someone would assume is a bank account. Same with foreign income. Let's say someone had interest income reportable, and so they reported their US BOA, Wells Fargo, your standard cast of characters. Maybe they have some Vanguard funds and things like that. But maybe they had $30,000 of unreported foreign income, and you think, well, obviously they were trying to hide that. There's no way that person could be credible. There's nothing that they could say that would make anyone believe that there was a legitimate reason why. Well, let's say, for example, 2 common situations we come across here. 1, let's say it's an Asian country where passive income is typically not taxed. So maybe they have dividends or capital gains or interest income, and it's not taxed in that country, so they didn't think that they had to report it. They reported all of their other income, so any 1099 that came in they reported. They just didn't realize that income that is exempt overseas is not necessarily exempt in the U.S. Another very common situation, and this gets complicated, but from a baseline perspective, a lot of countries that the U.S. do not have treaties with have pension plans, like a CPF in Singapore, an MPF, EPF, not Thailand, because there's a provident fund in Thailand, but there's a treaty there. And so oftentimes people will think, well, that's just a pension, that's privatized Social Security. The money is growing within the fund. It hasn't been distributed. Why on God's green earth would I have to report that as current income? But typically the IRS requires growth within these types of pension type of funds to be taxed. It may receive 401k treatment in the foreign country that it's in, but the U.S. doesn't recognize it, especially if there's no treaty. Okay, and so yeah, maybe the person has $30, $60, $100,000 worth of unreported income, but that income is just accrued income. It hasn't been distributed. They didn't know, and so yeah, while it was the higher balance income or the higher amount of income that wasn't reported and the small interest income in the U.S. was reported, it's because they didn't know. That type of income is reported. Another situation is when there's a U.S. bank that has, like Citibank, they may have accounts and they may have branches in India, and so even those Indian branches will issue a 1099, so the taxpayer reports the $90 worth of interest income they have from Citibank, but maybe they left out the $10,000 or $20,000 of interest income they have from other Indian banks like SBI or ICICI, things like that. Why? Well, they didn't get 1099s from there, so they didn't know that they had to report that. So the idea is the person has to present the information as credible, and you should never off the bat just assume that because there's a large amount of income that wasn't reported that the person is not credible. Credibility, super important, based on the facts and circumstances. It can mean the difference between a fraud penalty and qualifying for non-willfulness under the streamlined programs. One other final thing they might look at is whether you were truthful if you're in an audit. Let's say you're in an audit with the IRS and they're asking questions. You're like, yeah, I have these foreign accounts, or yeah, I have income. They go, why didn't you report it? You go, well, it's not taxable in Taiwan, or it's not taxable in China or Hong Kong. They don't tax you on that income. I didn't think it had to be reported in the US. And if you kept that strain of thinking going the whole time, and the agents, special agents, the courts, that they're looking back and they see that you've always taken that position, you just didn't know any better, well, then that could be credible, despite the fact that it's a large amount of unreported income or unreported foreign accounts. If you're out of compliance and you're thinking about getting into compliance and you haven't been audited yet, you're not embroiled in anything major yet, you may consider one of the offshore disclosure programs. There's the streamlined program, there's voluntary disclosure, reasonable cause, and delinquency, all depending on your specific facts and circumstances. You should reach out and speak with some board certified tax law attorneys to get the lay of the land. We have lots of free information on our main website, goldinglawyers.com. You can always reach out and schedule a reduced fee initial consultation if you think it's appropriate. Again, my name is Sean Golding, Golding & Golding. Thank you for your time. Enjoy the rest of your day.